Well, thank you very much. Good morning, everybody. My name is Yuichi Murao. I'm from Nomura Asset Management. And it's a very honor to be here, to be invited by this great conference today. I joined Nomura in 1990 and became the portfolio manager of the Japanese equities in 1998. So today's topic for us is the Japanese equities growth or value trap. And this agenda is accounts who are very cautious about investing in the Japanese equities because of their experience since the 1990s. However, the younger generation might have slightly a different view on the Japanese equity markets. Because as you know, the Japanese equity showed quite a nice return, almost identical return to other global equity markets, especially after the GFC. And by the way, I brought my junior colleague Nagano-san with me today, and he said that he joined Nomura in 2009, which means that he was actually looking for the job opportunities in the midst of the global financial crisis. And I'm sure he's going to be a very good manager. And he's managing the growth fund for the Japanese equities. So many people in the younger generation would see some opportunities for the growth in Japan as well. And as the time passes and these ample financial assets are moving towards the younger generation and who never have the bad experience of a long-term deflation or long-term stagnation in Japan, I think the Japanese markets would finally be welcomed by the Japanese domestic investors, not solely by some very eager fan of the global investors of the Japanese equity markets. Anyway, today I want to talk about some recent updates on the markets as well as some investment opportunities that we believe are missed by some global investors as investment opportunities. The first one that I want to talk about the current global market cycle, how we look at the global market cycle as well as the Japanese equity market cycle, and maybe the monetary policy implications from this outlook. And secondly, I want to introduce some unique fundamental conditions that we are seeing in the Japanese domestic economy, which I think is vital for many global investors to have some rationale to invest in the Japanese equity markets. And I think the Japanese domestic economy is now faring better than the other markets right now. And finally, I want to introduce some of opportunities. Valuation is always cheap in Japan, but people say that this is because of the very low return on equity, and I do not disagree with this. I agree with that. But if you look into the detail or the bottom line of the markets, you can see some different perspective on this one. So I want to introduce that one. And finally, I just want to touch on some recent political policies by the Kishida administration under the name of the new form of the capitalism. All right. For the first one, about the global business cycle, as many our colleagues or investors, we view that the global economy should slow down this year, following the sequence of the monetary tightening in the US and other markets, including Europe. And the situation that slightly different from the past cycle, slowdown cycle, is maybe the US household sector. The household sector, US household sector is in a much, much better shape in terms of the financial leverage. In the GFC area, their household sector was quite highly leveraged, and so the higher interest rates sort of abruptly killed the consumer spending in the US. But this time around, the debt ratio of the US household sector is relatively low and steady balance sheet. So even though the Fed continued to raise rates, it takes much longer than we anticipated that we see the slowdown of the private consumption in the US. However, we view that this will have some end. This game would end at a moment, and we think that the US economy should see some slowdown towards the second half of this year and next year. And another point that we have to bear in mind is about the Chinese reopening, and this is also going to support the global economy too. But the impact of the Chinese recovery also will be very limited in this sense, because we think that the Chinese recovery is mainly driven by the Chinese domestic recovery, especially in the service industry, not the industrials and not the manufacturers. And manufacturers in the Chinese market is typically have a businesses with the global markets, US or Europe, and they export these goods to these regions. And so in order for them to be more positive on the economic outlook in China, we have to see the recovery of the economy in the US and Europe, and which we do not expect to happen. So the Chinese recovery also will be give some sort of a very limited impact on the global economy. So while we see that the Chinese economy should grow to roughly 5% of the GDP for this year, but we basically view that the US economy to slow down to less than 1% of the GDP growth rate for this year. So in total, the global economy, the developed economy should see a notable slowdown this year. And as such, we expect the central banks, including the Federal Reserve, would stop raising rates in the middle of this year, and people would start talking about the rate cuts towards the next year. So this might not be a very unique view. I think that this is the shared view among the investors right now. And under this condition, let me just briefly touch on the BoJ's policy making, which I think is one of the issues that many people were most interested. And 2 days ago, the Nikkei article released some news that Mr. Amamiya will be the next governor for the BoJ for this April. And as you know, Mr. Amamiya has been working very closely with Mr. Kuroda. So our view is that the entire framework of the monetary policy by the BoJ would not change significantly. And the framework of the the BoJ has been the YCC, QE, and the negative interest rates policy, and asset purchasing programs for the equities and so forth. So we have everything, almost everything. BoJ has almost everything. And as you know, the last December, BoJ actually adjusted the YCC fluctuation band range from 25 basis points to 50 basis points, while it's still pinned the 10-year JGB level at 0. And so people are now talking what will be the next move for the BoJ in association with what would happen if the BoJ governor would change. And as I said, there should not be a big change because Amamiya-san is going to be the governor. But we still believe that there should be some sort of adjustments of the monetary policies towards mid of this year. There are some choices, of course, for the BoJ. One is the change of the negative interest rate policy to get rid of the negative interest policy rates to make it positive. I do not think this would happen. This would clearly indicate that the BoJ should phase into the monetary tightening cycle. And I think it is too early for BoJ to do that, and the Japanese economy is not growing as strong as the situation that BoJ can allow it. The second option might be the further expansion of the fluctuation range of the YCC, and I think it's possible. Maybe 75 basis points is okay, maybe 100 basis points. And however, this program might have some caveat because one of the reasons for the BoJ to take the action in December was not actually the easing, but to restore the market functionality in the bond markets. As you know, the bond markets are now suffering from a very low liquidity, especially in bond JGBs at the 10-year maturities. Almost 50% of the JGBs held by BoJ, and in some cases, some names, almost entire portion was held by the JGB. BoJ. So it's very difficult for them to make a pricing of the corporate bonds or make some the tradings in the marketplace. So in order to restore the market functionality, the BoJ actually introduced the wider band range of the YCC in December. And even though we see some much wider range of the 75 or 100, it could happen again. If BoJ set some level of the interest rates, there will be lots of investors to attack the set level, to challenging the BoJ to abandon the YCC. So it may not be a very effective way for BoJ to implement adjustment to the YCC. And third choice might be to shorten the control duration of the JGBs to control this YCC. And it is actually already in place. BoJ actually intervened into the 5 years maturity bond markets already and to reduce the yield of this particular maturity. And so I think there's some, together with the newly introduced open market operation, which was introduced in January, which actually provide ample liquidity into the marketplace and give an opportunity for many of the private financial institutions to take advantage of the arbitrage opportunity by borrowing the money from BoJ and to putting their money into the bonds, which have a higher yield with a corresponding maturity. And so this is a kind of a derivative of YCC, which involves all the market participants in the marketplace. And so I think the shortening the duration is already introduced by having this monetary operation, the open market operation with a much shorter duration. So the final choices that BoJ might have, I would say, is to abandon the YCC in reality while keeping the YCC framework in name. So they just say that we will continue the YCC, but we will do whatever to make the yield curve of the JGB markets appropriate, something like that. So they will have a discretionary discretions for the all maturity of the markets. And this is quite identical to the policies that are taken by the BoJ for the Japanese equity purchases program, ETF purchase program. JGB actually set a 12 trillion yen of the purchasing budget for the Japanese equity ETF. And they do this when they buy into the market when the market collapses. But while they keep the target of the 12 trillion yen, they never touched this level over the last several years. They just simply say that we will do when appropriate to buy into the market by keeping the target of the 12 trillion yen. So this sounds like quite identical to the YCC without any specific bond deals, without any specific yields. They will do what they believe to be appropriate in the marketplace. So this is something that our economists and we look to see when BoJ would do the next round of some adjustment on their current framework. And the problem would be the timing. Timing-wise, the governor would change in April. The deputy governor will change in March, 1 month earlier than that. And we think that they would not implement this sort of a drastic changes right after the new board starts. So what we expect to happen would be maybe June or July. Policy meeting would be some timing that we might see this sort of adjustment. And this timing is also very important because the wage negotiation, the spring wage negotiation between the corporations and labor unions are down in April and May, and they will see how high the wage growth would be by the end of June and July. So if the BoJ could actually identify some meaningful number of the wage hike, together with some decent rise in the CPI, this could give quite a good rationale for the BoJ to another action to make adjustment. So the timing we expect to happen would be maybe June, July. Well, by the way, the BoJ actually surprised the market in December, so I'm not very much confident about that, but this is our basic scenario. Okay, so this is about the BoJ, and so the monetary policy-wise, we think that the Fed would stop raising rates in the middle of the year and foresee some cut in the next year, and Japanese YCC would see some adjustment. And under these conditions, what would happen in the exchange rates? And we think that the Japanese yen would appreciate following these movements, especially driven by the monetary policy change by the Federal Reserve. As you can imagine, if the Fed stops raising rates and starts to cut rates, then naturally we expect the US dollar to fall. And our current range of the US dollar Japanese yen is 120, 130 for the next 12 months. And since we expect the global economy to slow down and the Fed starts rate cuts, we think that the global interest rates also should start fall. So for the range of for the U.S. Treasury range of the 3% or 3.5 and something like that. And under this scenario, we expect that the JGB yield would also come down to a lower level than current situation. Currently, the market is attacking BoJ at the level of 50 basis points, but we think that the fair value range of the JGB 10-year yield would be somewhere around the 30 basis points or 40 basis points, given the current inflation rate in Japan and also the lower interest rate in the global markets, including the US. I think the Japanese yen should not rise as high as 80 basis points or 90 basis points, which somebody might expect. So under this condition, I think the BoJ are happy to lift off all the YCC targets because that's the outcome that they want to see. Even if they abandon the YCC, they can maintain the low interest rate in the marketplace in a free way. Okay, so this is about the exchange rate outlook and the monetary policy outlook for Japan. Now let me move on to the second part about the fundamental conditions in the Japanese. We think that the Japanese GDP numbers would be higher than those in the US or the Europe for this year. If you look at the quarterly numbers, we will see Japanese GDP number would continue to outperform the GDP numbers of the other markets. And one more reason is the very, very steady Japanese domestic demand, one of which is the private consumption. And the chart on the left shows the forced saving amount in the Japanese household sector. Japanese government spent a lot of money to save the businesses and household sector under the pandemic. So in 2020, we saw quite a substantial increase of the savings in the Japanese household sector. And this savings remained at a very high level up until recently. If you look at the other economic indicators like disposable income and the comparison with some of the spending, private household spending, the gap between these two economic indicators continue to widen, which means that they are not spending enough money from what they earn from their businesses or their salaries. Meaning that the Japanese household sector is actually sitting on the bank accounts with a very, very high amount of money. Now, it looks like people started to spending some money, even though we do not expect that the Japanese private consumption should rise 3% or 4%. It's not really something that we expect, but the private consumption in Japan could be like 2% or 3% under this current situation when the nominal prices in Japan is also rising, and they are having the savings, so they are actually paying a much higher amount of the money in a nominal basis. So the Japanese private consumption should result in a higher growth for this year. And on top of that, we expect that the foreign tourists to come to Japan after the easing of travel restriction in Japan. Actually, it happened several months ago, and we are now seeing the increasing number of the foreign people visiting Japan for the sightseeing. Very weak Japanese yen also support them to come to Japan. So right before the COVID in 2020, we saw quite a nice support from foreign tourists to the Japanese domestic spending, and Japanese economy was actually supported by the spending by these foreign visitors in Japan. So with these two engines, we think that the Japanese domestic demand would be very, very robust, and especially in the service industry. For the corporate sector, on the right-hand side, you can see this is the Tankan, the BoJ survey about the attitude of the corporations towards their fixed income, fixed investment. And usually this number is trending down towards the end of the fiscal year. But as you can see, in 2022, the attitude of the corporations, the plan for the capital expenditure is rising, still rising, and it's still steady, very steady. And one of the reasons for this very aggressive capex attitudes by the corporation is the shortage of the labor force. As you can imagine, Japan is an aging population society, and the labor population has declining recently. In fact, the labor population was increasing under the Abenomics period, 2015, 2016. We saw a lot of female people started work. The labor participation rate of the female labor force was continued to rising, and which supported the labor population at that time. And also the elderly people who once retired from the labor market also came back to the labor market as a part-time labor force. And so the labor participation rate of the elderly people also rose quite substantially, supporting the labor population in Japan. However, after spending 5 years, and these elderly people got to the age of 70, and they are now, in reality, they are now retiring. So there are very tight demand-supply conditions in the labor markets, and the corporations need to do something to replace the human labor force into something else. So some digital transformation, introducing some nice software and very efficient program and so forth. These are the vital investment targets. And also in some manufacturing sectors, we have robots or automation systems and sensors or the cobots. And these are now also supporting the shortage of the labor force. Another reason for the aggressive capex attitude would be explained by the deglobalization. As we are aware that there is some U.S. and China tension, and the supply chain needs to be rebuilt so that they are not independent each other, especially for serious technologies, state-of-the-art new technologies. They cannot rely on each other. So sort of a double investments in each category, in each group is happening right now. And especially in the semiconductor industry, which is, of course, the most important industry in many aspects in the technology and their weapons and so forth, there are lots of investment plans, not only globally, but also in Japan as well. For example, the TSMC decided to build the fab in the Kyushu district in Japan. And this is a huge value chain. The semiconductor industry have a very long value chain with many of the electric components or the basic materials and so forth. So the Japanese suppliers for this TSMC is also planning to expend very much of money into building the factories in the same region. So the capex is very much driven by this sort of a deglobalization and the need for the procurement of the goods and products. And on top of that, the decarbonization would be another area that we see some constant investment. In order to abide by the Paris Agreement to reduce the carbon emission, the new technologies to reduce the greenhouse gas emission is now being implemented everywhere. So this is another driver for the capital expenditure. And so these combine to generate a quite decent growth of the capital expenditure in the domestic market. And finally, I would say the weakness of the Japanese yen is the reason for the investment in the Japanese domestic place. Now, we have a much cheaper labor force in Japan than, in some cases, than in China. So it's rational. It's reasonable for many Japanese exporters to build a factory in Japan and export them to overseas. So some of the auto parts makers announced that they plan that they would create a new factory in Japan. So the weak Japanese yen also work in favor of the capital expenditure in the Japanese domestic space. So both the private consumption in the household sector and the corporate sector are now seeing quite a nice growth for this year. So this is one of the reasons that we expect to see a higher growth rate of the Japanese GDP for this year. And this is also can be translated in the resilient corporate profits. Maybe I forgot to attach the corporate profits chart. But the corporate profits in Japan is also faring very well. Last year, the corporate earnings revision index suggested that the US or Europe or some Asian companies downgraded the earnings through the year from the beginning of the 2022 to the end of the 2022. However, during the same time during the same time, the Japanese corporations registered upgrading of their earnings, partly supported by the weak currency, but partly supported by these very resilient activities of our Japanese manufacturing sector. So the Japanese corporate sector is now also faring better than the other markets, and now we think that we will probably see some downgrading of the other non-Japanese corporations from this quarter and onwards, but I think the magnitude of the downgrading on the Japanese companies would be relatively small. So then, okay, fundamentally it might be better, but it's going to be just one-year theme for Japan to be better placed for the global investors. And so I do not really disagree with that, but I want to touch on something much longer time horizon, which I think is the valuation and the relationship with the return on equity. But Japanese market is always said to be the very cheap markets. Currently, the price-earnings ratio is 12 times for the TOPIX index. TOPIX index is a very, very broad index with 1,800 names included in this broad index. But if we explore the contents of this index, we can find some interesting situation. Roughly 20% of the corporations out of this 1,800, they are generating a return on equity of more than 15%. So we have roughly 400 Japanese corporations who are generating more than 15% of the return on equity in Japan for long decades. Meanwhile, the S&P 500 is, of course, the 500 names. There are 500 names. So the size of the universe is totally different, but they have roughly 60% of the corporations generating a return on equity of more than 15% again. So if we compare both markets, companies with the return on equity higher than 15%, well, okay, S&P have 300 names, and now Tokyo has 400. So even though the ratio is very low in Tokyo, but you can identify a very nice, good, growing stocks from the investment universe, which is big enough for the global investors to choose from. We have roughly 400 names generating return on equity of more than 15%. And more importantly, these companies are traded at a much lower valuation than the US peers. That is shown on the right-hand side. This is the comparison of the price-to-earnings ratio since 1990s between the S&P 500 topics. In both cases, we chose the companies with a return on equity of more than 15%. And we used to have a similar valuation until the GFC, but after that, the US market continued to go up while the Japan remained relatively lower end. And my understanding about this is the extremely accommodative monetary policy globally would result in money inflow, money concentration into the US market, pushing up the valuation of US GAFA equities to reach the highest level until to 2020. But now that the market condition is heading toward a totally different way, I mean the monetary tightening. And so the monetary tightening works unfavorable for the US peers, while Japanese companies remain relatively stable. And so the gap between these two groups are now narrowing. So what I want to say is, if you want to buy companies with a high growth rate or high return on equity, okay, US is good, I agree with you, but you can also find good corporations with a high growth rate and high return on equity at a much cheaper price in Japan. So these are some opportunities that we think that many of the global investors are underestimating. So there are lots of opportunities in Japan too. And let me just talk about a bit about the value and growth, which I think is another very popular question that we receive from the investors. On the left-hand side chart, you can see this is a comparison of value growth index in blue, the growth over value in blue, and orange line shows the US Treasury yield of a 10-year maturity. And as you know, it moves in tandem. So when the interest rates, by the way, the U.S. Treasury yield is an inverse axis on the right-hand side. So when the interest rates gets lower, the growth stocks outperform, and vice versa, and so forth. And now that the interest rates gets higher to the 4% last year, and now coming down to the level of the 3%. And likewise, the growth stocks underperformed quite severely until recently, and now they are range-bound for now, to some extent. So our outlook for the growth and value, I would say we are almost neutral, because we believe that the global economy to slow down and the global interest rates should come down, which works in favor for the growth stocks. So I think that the growth stocks underperform should stop. But we do not expect to see a situation where interest rates continue to fall and long-term bond yields gets lower to the below zero. This is not the situation that we foresee. As we discussed maybe in other places, we have a totally different, maybe the era. We are entering into a totally different era from the past 20 years, which is a disinflationary era. Now we are entering into some sort of an inflationary era. There are some structural pressures that push up the prices everywhere. The decarbonization that I mentioned, this is the energy security problem. But if you want to reduce the emission of the gases, you have to get rid of the very cheap energy sources and to invest in the solar panels or the batteries and so forth. So this is naturally inflationary. And also deglobalization, this is also the very inflationary. So we have to be very, very careful about the inflation outlook, and we do not expect that the deflationary pressure would sustain for the next year onwards, even though in the short term we think that the global inflation and bond yields should come down. So we do not expect that either the value factor or growth factor to securely outperform in either way. So this is just a brief touch on the relative performance outlook of the value and growth. And some other opportunities, maybe I'm running up the time, so I will just quickly sum up. Well, there are lots of industries that we can introduce for you. The very, very competitive areas of the Japanese corporation is the factory automation, or the information society is something that digital transformation is very, very important for the Japanese companies to be effective. So this is the areas that we're focusing on in building the portfolio for the growth strategies. And finally, this is Mr. Kishida's new capital framework policies, and they focus on the human resource investment and science, technology, and innovation, and startup businesses, and GX and DX, and virtuous cycle of investment and distribution. These are the focus of the Kishida administration's framework. And many people say that this is a rather supply-side policies, which takes time before we see the real impact on this. So it may take some time. But as you can see, there are lots of initiatives related to the capital spending. Capital spending is encouraged, and the predictability of the projects is very important for the Japanese corporations to make capex. Japanese corporations have risen the return on equity through a higher leverage by paying out the dividends, by buying back the shares, and higher leverage result in a higher return on equity, but associated with a lower valuation, because in some cases that indicates that there are no investment opportunities for these corporations. But nowadays we are seeing some investment capex opportunities for the Japanese corporations. I hope this change of attitudes by the corporations towards more capex rather than the shareholders' return could generate a higher perception about the Japanese companies. Well, thank you very much. I'm running out of time. Thank you. I will end up my presentation here.